Options are derivative contracts that provide the holder with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before or at a specified expiration date. A call option gives the holder the right to buy the underlying asset, while a put option gives the holder the right to sell it. The seller or writer of the option assumes the obligation to fulfill the contract if the buyer exercises the option. Options are widely used for hedging, speculation, and income generation. The program emphasizes option fundamentals because options provide flexible risk management tools and are central to modern financial markets and derivatives trading. Option positions can be classified as either long or short depending on whether the investor purchases or writes the option contract. A long call position profits when the underlying asset price rises above the strike price, while a long put position benefits from declining asset prices. Conversely, a short call or short put position generates income from premiums received but exposes the writer to potentially significant losses. Options may also be categorized as in the money, at the money, or out of the money depending on the relationship between the strike price and the current market price of the underlying asset. Understanding these payoff structures is essential for evaluating risk and return characteristics in options trading strategies. Options can be written on a wide range of underlying assets, including equities, stock indices, bonds, interest rates, commodities, currencies, and futures contracts. Equity options are among the most common and are typically exchange-traded with standardized contract specifications. Index options allow investors to gain exposure to broad market movements rather than individual securities. Commodity and currency options are widely used by corporations and investors to hedge against fluctuations in raw material prices and exchange rates. Some options are physically settled, requiring delivery of the underlying asset upon exercise, while others are cash settled. The diversity of underlying assets makes options highly versatile instruments for financial risk management and investment strategies. Option contracts contain several important specifications that determine their value and trading characteristics. Key contract terms include the strike price, expiration date, contract size, settlement procedures, and exercise style. American-style options may be exercised at any time before expiration, while European-style options may only be exercised at expiration. Exchange-traded options are standardized and regulated, promoting liquidity and transparency. The Options Clearing Corporation, OCC, guarantees contract performance and records all option positions, significantly reducing default risk. Standardization allows market participants to trade options efficiently in organized exchanges while benefiting from centralized clearing and daily settlement mechanisms. Options trading involves unique risks and opportunities because option values are influenced by multiple factors. Important determinants of option prices include the current value of the underlying asset, strike price, time to expiration, volatility, interest rates, and expected dividends. Leverage allows investors to control large exposures with relatively small premiums, magnifying both potential gains and losses. Writing uncovered options can expose traders to theoretically unlimited losses, particularly in short call positions. Investors therefore use various trading strategies such as covered calls, protective puts, spreads, and combinations to manage risk and achieve specific investment objectives. Effective option trading requires careful analysis of market conditions and risk exposures. The program highlights options as essential derivative instruments for hedging and portfolio management. Financial institutions, corporations, hedge funds, and individual investors use options to manage market risk, generate income, and implement directional trading strategies. Exchange-traded options offer liquidity, transparency, and reduced counterparty risk through centralized clearing systems, while customized over-the-counter options provide greater flexibility for specialized hedging needs. At the same time, options introduce complex pricing dynamics and nonlinear risk exposures that require sophisticated analysis and monitoring. Understanding option types, contract specifications, trading mechanisms, and payoff structures is therefore critical for financial risk professionals responsible for managing derivative positions and market risk exposures.